Oke, Pak Rahmat.
Ya, selamat malam semuanya. Saya izin pakai bahasa Indonesia dulu ya. Jadi ini teman sebaik saya, Steve Balaban dari Toronto, Kanada, datang ke Indonesia sudah 3 tahun berturut-turut. Dia adalah seorang yang ahli dalam private equity. Dia juga punya kantor sendiri, private equity. Ada juga networknya yang bisa menyediakan dana untuk investasi di Indonesia. Dia akan membawa ini topik global trend di private equity. Jadi time is yours, Steve. You are still mute, Steve.
I was Thank you. I was just testing you. You passed. So thank you so much. Terima kasih. Salamat malam. Thank you all for having me. I really appreciate it. It's morning over here in Canada, but I hope you all had a great day today. And I'm looking forward to talking to you about the biggest trends in private equity that happened in 2025. Now, fun fact, I was just watching the videos there, and I see you have a lot of excellent in-person events over in Indonesia. Well, great news. I'm looking forward to seeing you all and hopefully meeting you in person when I'm in Jakarta next month. I find it's always such a homey, great hosting atmosphere in Jakarta, so I always love being in Indonesia. So, looking forward to hopefully seeing you. But that's not what we're talking about today. Today, we're talking about the private equity industry. Now, we're facing a lot of global uncertainty, and interest rates are at a very high rate in comparison to what they were in the 2010s. And so the question everybody has is what does the future of private equity look like? Is it going to be the end of the golden era of private equity? Or is the private equity industry going to be resilient and continue to outperform many of the other asset classes in the future? Well, today we're going to talk about the three biggest trends that are in private equity globally today. At the end, we'll give you a little bonus trend that is also happening. And after we talk about our trends, I hope that you have a little more insight into what you think the future of private equity is like. So, the first major trend in private equity today is the challenging fundraising environment that the industry is facing. Now, to fully understand how fundraising works and what's going on today, I'm going to bring you all the way back to the beginning of the private equity industry. Now, not the real beginning, because the real beginning of the private equity industry is hundreds of years ago. After all, you're just buying equity in private companies, which means that you're investing in the ownership stake of private companies. And think of it. For hundreds of years, private companies were getting investors to give them capital to help them grow. But the private equity industry, as we know today, was really started in the 1970s in New York. There was an investment bank called Bear Stearns, and three people named Kohlberg, Kravis, and Roberts, they worked on deals that are now called leverage buyout deals. And they tried to build actual structure of an investment structure in Bear Stearns. It didn't end up working. Bear Stearns didn't approve it. They ended up rolling out a private equity firm called KKR, and KKR was the first private equity firm in the structure that we have in today's world. Now, before I continue, there's a fun fact I'd like to share, and I have to share this because I'm Canadian. So there was a fourth person at Bear Stearns that was working on these leverage buyout deals, and that fourth person also created a private equity firm. Does anybody know who that fourth person was? You can write it in the chat if you know. Anybody know? So this is at Bear Stearns. There was Kohlberg, Kravis, and Roberts that created KKR that were at Bear Stearns. And there was someone else that was in Bear Stearns that later became a billionaire. Anybody know? You try it. Jay, that's right. So Jay is one of my students from the University of Waterloo. So Jay, great to see you. Jay is correct. It was Jerry Schwartz. So Jerry Schwartz is Canadian. Jerry Schwartz worked with Kohlberg, Kravis, and Roberts. Jerry Schwartz, instead of staying in New York and starting KKR with the other three, he ended up staying at Bear Stearns another year, came back to Canada, started what's called CanWest Global, and then a few years later started Onyx, which is one of the biggest private equity firms in Canada. So when KKR started its private equity firm, it started just doing deal by deal. But what ended up having to happen is they wanted to raise a fund. They wanted to raise more money to invest in multiple companies. Now, you have to understand the private equity fund structure to fully understand why there are challenges in fundraising today. So let me back up a second, explain the private equity fund structure that was started by KKR, which most private equity firms around the world use today. So think of it this way. If I'm investing in the public markets and I want to create a fund, a mutual fund, a hedge fund, or any type of fund, and I'm raising capital from investors, I'm going to raise all of the capital up front because I can buy stocks right away, right? So I can buy stocks in the next week, and then I can deploy all my money in the stock market. But in private equity, you can't do that. Why? Because we're buying private companies. So if you buy a private company, you need to find the company that you're going to buy. And once you find the company you want to buy, you have to first make sure they're for sale. And then if they're for sale, you need to negotiate a deal. You need to conduct detailed due diligence, and then you buy the company. This process of proprietary deal flow, deal sourcing, and due diligence, this takes time. And so, because it takes time, you can't just take all of your money from the investors up front. So the way a private equity fund structure works is you end up taking investors' commitments. So you get a bunch of investors to commit capital to you. Then once you have the commitments, you take a portion of that, let's call it 20 to 30%. Then you take the 20, 30% and you invest it in companies. And then as you find other companies, you call more capital. It's called a capital call. Then you create value in the companies. Then you end up exiting the companies and you sell them and give the money back to the investor. So in private equity, we don't have the same structure as a hedge fund or a mutual fund. You have a closed-end fund. Now, a closed-end fund usually is 10 years in length because it has to give the private equity firm enough time to raise capital, to call the capital, to invest the capital, to give the money back, and for the investor to get the money. So it gives them like 10 years to do it. So it's usually 3 to 5 years once they buy the company, but it gives it the 10-year fund structure, gives it a lot of time. Okay, I'm going to go back to my history to go to KKR to get to today, and then I'm going to go back to the fund structure to explain to you why fundraising is challenging today. So when KKR started raising funds, as did other private equity firms that were started, such as Blackstone and other big funds in the US, they were starting to raise funds that are 10 years in length. And the way it works is after you raise a 10-year fund, okay, then you start investing. But usually in year 3 or year 4, you start raising a second fund. So you don't wait 10 years to raise a second fund. That'll take too long. So you start fundraising usually after
Iya,
a few years.
Mul.
So, yeah,
Kenapa?
so I think, Rama, maybe we want to mute that person, but it's okay, unless it's a
Yes.
question I need. Do I need to answer that question?
No question asked.
Okay, awesome. Okay, so we have a private equity fund structure as 10 years, and then after 3 years, you have extra fundraising. Okay, so KKR, Blackstone are raising these funds, and they raise a second fund, a third fund. They keep on raising a fund. Now, in the 80s and in the 90s and in the 2000s, the private equity industry slowly growed. And then it got bigger and bigger in the mid-2000s. Now, after the financial crisis in like 2009 and 2010, a lot of people got scared of the volatility in the public markets, plus the interest rates were at an all-time low. Now, remember, I talked about a leverage buyout that KKR did, where they're buying companies with a lot of debt. And if you're buying companies with a lot of debt and interest rates are low, this is going to fuel the private equity industry. And so from 2010, we call it the post-financial crisis era, going forward, from 2010 going forward, the private equity industry boomed. So it was hard for people not to raise money. All these new private equity funds were started. All the big private equity firms were raising more than they were asking. Everybody wanted to give money to these private equity funds. So in 2010, 2011, 2012, 2013, 2014, everyone is giving these private equity funds money. Now, before I continue, I just want to tell you who everyone is. I know we have a lot of people on the webinar today. I see that we have over 60 at the moment. So I don't know how many people fully understand the details of private equity. So I'm going to go a little bit of basics, but I'm going to go to be more advanced a little later. So one of the basic part is who gives money to private equity firms. And traditionally, it's sovereign wealth funds, it's pensions, it's endowments, it's family offices, right? A sovereign wealth fund in Indonesia would be INA, now rolled into would be Danantara. Sovereign wealth fund in Singapore would be GIC and Temasek. And these are the type of sovereign wealth funds that would invest in private equity funds. Okay, so these investors are investing in these private equity funds in 2010, 2011, 2012, 2013, 2014, 2015, and so on. And every few years, the private equity funds are going back to these investors to put more and more money. Okay, but what happened in 2020? So in 2020, we had a challenging environment with COVID. And as you've been following for the last 5 years, there's been a few ups and downs when it comes to the private equity industry. But remember, we have a 10-year fund structure. And remember, in 2014, 2015, and 2016, we have all of these investors that are giving money to the private equity industry. Now, they've been giving money in 2010, 2011, and they continually give more and more and more money. So if you give a lot of money to a private equity industry that has a 10-year fund structure, and you give them the money in 2015 and 2016, you can guess, when do you expect the money to come back? Well, as the investor, you expect the money to come back within 10 years. So where are we today? Today, we're in 2025. Now, in 2025 and in 2024, it's been a challenging market for the private equity industry, right? The interest rates have been higher. The overall global economy has been having some challenges. Right now, there's a lot of uncertainty globally, politically, as well as in the private equity industry. And so, the private equity funds are having trouble giving the money back to their investors. Now, traditionally, if I'm a private equity fund and I'm investing in companies and then I have to sell them to give them to investors, I usually have 3 different types of people that I sell them to. One, I'll sell them to strategic buyers. So for example, if I'm a grocery store owned by a private equity fund, the private equity fund will sell the grocery store to a bigger grocery store as an exit. Second option is a financial buyer. They might sell it to a family office directly, a sovereign wealth fund directly, or to another private equity fund. And the third option is to bring it public. Now, the most common way to bring a company public is through an IPO, but sometimes, such as Spotify, when it went public, it could be through a direct listing. And back a few years ago, a lot of companies went public through SPACs, which I can get into the Q&A if you're interested. So usually you sell companies to a strategic buyer, a financial buyer, or you bring it public to the public markets. But the private equity industry has been having trouble selling these companies at the prices that they're valuing the companies at. So but let me just go into a little more detail on how a company gets valued by. I think I got muted, but I'm unmuted now, so it's okay. So let me go into a little more detail on how a private equity fund values its companies. Then we'll talk about why it's having challenges getting that value. And we're going to bring it all together to our first main trend on challenging a fundraising environment. And just to repeat a little back what I said. So we have a 10-year fund. We have private equity funds that were raising a lot in 2010, 2011, 2012, 2013, 2014, 2015, 2016. And now they're having trouble exiting. And they're having trouble exiting to strategic buyers, financial buyers, and they're having trouble exiting to the public markets. Okay, so what happens is in your 10-year funds, when a private equity fund is buying the companies, every 3 months they have to report to the investors what the company is worth. But here is the problem. The companies do not trade on the public markets. The companies are private. Why? Because it's a private equity fund. And so if a company is private, what ends up happening is the private equity fund has to get an independent valuation for each of the companies every 3 months. Now, the challenge is finding an independent valuation because, after all, the private equity funds are the ones that hire the valuator, right? And so there's a lot of conflicts of interest when it comes to valuation. And so what ends up happening is a lot of the values in the companies owned by the private equity firm, some of the investors believe the values might be higher than the actual companies. And so we are now at the end of a fundraising cycle. And if you're at the end of a fundraising cycle, after they've raised all their money and they have it in their fund, it is hard for them to sell at the values that they're saying they're gonna exit at. And so that is the challenge that private equity funds are facing today. Now, I'm gonna dive deeper in a second, but I'll stop to see if anybody has any questions. So if anybody has any questions so far on the fundraising cycle, the challenges that are getting faced with the exits, what that means, please feel free to write it in the chat. I'll take maybe like 30 seconds to answer any questions you have. Otherwise, I'm going to go a little bit deeper, and I'm going to go deeper, just so you know where I'm going next, is into the second biggest trend, which is called GP-led secondaries. That's been growing a lot, which also goes into why there's fundraising challenges. I think we have a hand up, I see. Is it Jovian?
Yes, sir. Thank you for the opportunity. So my question is, uh, from what I heard, that the United States is starting to cut their interest rate. So my question is, how do you think that this will affect? Because uh, yeah, by cutting the interest rate, I think other countries also going to cut their interest rate too, which I think that it might cause some change in the private equity market. Thank you.
Great, Jovian, fantastic question. Okay, so just to repeat Jovian's question is, what happens if the interest rates get cut? And so I'd actually say, depends on how far the US cuts their interest rate. So at this point, we had the interest rates in around the mid-2000s around here, and they're still up here. So just by cutting it a little bit is not going to make the biggest difference. But if they if the US continually cuts their interest rate, and it gets to fairly low levels, I think what you'll see is the private equity industry not getting as affected as it was before. Another thing, just since you mentioned the US, to actually just maybe give some other comments before I get to the next question, is I also see you're going to see a lot of the US firms, kind of the sector-specific firms, a lot of sector-specific firms that are also manufacturing in the US. You're seeing a lot of money going into there, and then a lot of firms are going into a lot of money from the private equity firms are going into the firms that are actually moving, that are going to benefit from the tariffs, or one could argue benefit from the tariffs in the US. But I'll stop on that because no one asked that. I'll go over. I see another question in the chat. I see it from Esther, and I'll read it out loud. It said, what are the typical rationale for private equity to acquire or exit a target company? Okay, so a private equity fund usually has investors, and thank you, Jovian. And then so the way it works with a private equity fund is the reason why they're doing it is it's a business for them, right? So a private equity fund makes two types of fees. They make a management fee and a performance fee. The management fee is usually on committed capital, the money that they've raised, and sometimes it's on invested, the money that they call. But also they make money on performance fees, so on the upside. And so the idea of the private equity fund industry is to buy companies, create value, and sell them for more they bought it. That being said, there's also a typical rationale for, let's say, sovereign wealth funds to do it directly. I think you'll see a lot in Donantera. Donantera, I know, was created recently in Indonesia. I think there's $900 billion in Indonesia, and I think you'll probably see Donantera doing a lot of direct investments. I think it's kind of, you would probably all know better than me because you're in Indonesia, but I would make the assumption that Donantera is looking at the model from Singapore of Temasek and in GIC, where they want to invest in private equity, and they've rolled in a lot of your state-owned companies, such as your banks. And it'll be interesting, right? So for Donatera to buy a company directly, you're basically buying a company directly. You're investing in private companies with the intention, with the intention of creating value in the companies. And so if you're a sovereign wealth fund doing it in your own country, such as Temasek, which owns Singapore Airlines and the port in Singapore and many others, they're not just creating value like a private equity fund would be for management fees and performance fees. A sovereign wealth fund is actually creating value so that they actually have the money for their country. That is the intention of a sovereign wealth fund. Now, family offices will do it because their objective is to preserve their wealth for generations to come. And private companies are something that are held for the long term, and they may match the duration of what the family wants to do, as well as they might have family members that might sit on the board of some of the companies that they buy. So the rationale actually depends on who the investor is. So I give the example of a sovereign wealth fund, a private equity fund, and a family office. There's many other examples, but as I'm talking, I see the chat filling up. So maybe I'll go to the next question. So
Don't forget to present, Steve. Continue. Maybe you can go to the Q&A later.
Okay, so you want me to, okay, good point, Ramat. So why don't I'm just going to quickly look at some of the questions. Okay, so there's great questions in there. Why don't I just go through my second trend and then I'll stop again and then I'll go through the chat. Ramat, does that work?
Yes.
Okay,
Yes.
Terra Makasi. Sounds good. Okay, so just to remind, my first trend in private equity is that there's a challenging fundraising environment. Okay, now the challenging fundraising environment is because they're having trouble exiting to the three main channels. So now there's a new channel where many private equity funds are actually selling to, and that's the second biggest trend. Who are the private equity funds selling to besides strategic buyers, financial buyers, and the public markets? Who are they selling to? Actually, I was going to say to write it in the chat, but maybe don't write it in the chat because I need to make sure I don't lose all the questions. I need to answer the Q&A. So just think about it. You don't have to write it in the chat. Think about it out loud. Also, I see there's now over 90 people here, so please don't all write it in there because then I'll lose track of the questions. Okay, so think about it. Okay, so if you're not selling to a strategic buyer. Okay, so you're not selling to a company in the same industry. You're not selling to another private equity firm. You're not selling to the public markets. So who are you selling this company to?
It's okay, Steve. They can write in the chat. We keep track of the questions in the chat.
Okay, sounds good. Okay, thanks, Ramat. Appreciate it. Okay, so it's okay. Write in the chat. Who are the private equity funds selling to? This is one of the biggest trends in private equity today. And my hint is, I said it a little earlier. Okay, so Jovian, great guess. He's selling it back to the owner. That could happen, and that would be called a management buyout. That does happen. The challenge with a management buyout is a lot of times the owner doesn't have the money, but they could have the money through management buyout. So that could be possible, but there's another entity that buys it. And anybody else want to guess? Jay, who was just in my private equity class a couple of weeks ago, or last summer. So Jay, you're getting it. Okay, when you say secondaries funds, okay, maybe I won't let you answer this one because I know you've taken my class. So I'll let someone else, but I appreciate it, Jay. I love it. So what type of secondaries funds, and Jay, I know you worked at a company that does this. So what type of secondaries funds and end up buying? It's a specific type of secondaries. Any ideas? Jay, maybe I'll let you give everybody 30 seconds before I let you write it. Is that okay? And Jay, I appreciate you coming. This is great. While we wait for someone to answer, you're probably wondering what this QR code is. This QR code is to sign up for our private equity bootcamp. It's 2 full days in person in Jakarta, and then you can know all of these things and be interactive and meet lots of people. Alfin, awesome. Alfin gets a GP-led secondary. Fun fact, Alfin works for Mink Learning. So thank you, Alfin, for writing that. I really appreciate it. And good to see you. I saw you yesterday, but good to see you. And I look forward to spending time with you and the rest of our team, Marcel, Fadia, and Brian. I look forward to seeing you all in person in Jakarta. Awesome, Alfin. Okay, so Alfin's right. It's called a GP-led secondary. Now, let me explain what a GP-led secondary is. In the simplest terms, the private equity fund is selling the company to itself. So think of that. It's selling the actual companies to itself. So let me explain how it works And I'm going to give you an example with us. So it's called a continuation fund, which is a type of GP-led secondary. So if you have a private equity fund that is 10 years in length, and I'm in year 9, and in year 9, you're having challenges selling one of your companies. My finger disappeared. Selling one of your companies. So how do I sell the company to myself? So the way it works is we create a continuation fund. So the private equity fund creates something called a continuation fund. So the way it works is they go to their original investors. So remember, we have a 10-year fund that promises investors their money back after 10 years. So around year 9, they go to their investors and they say to the investors, would you like to continue to hold the company? Then the investors have 2 options. 1, say yes, and 1, say no. So what they do is about half of the investors say no and half of the investors say yes. The investors that say yes get rolled into a continuation fund with new terms. The investors that say no don't go rolled into the continuation fund. The investors that say no, what ends up happening is they end up selling their stake to someone else. Someone else buys it in a secondary transaction. Now, there are lots of big secondaries companies around the world, Collar Capital, HarborVest, Hamilton Lane, Pantheon, Partners Group. You might have heard of some of them. They will buy these stakes, as will other limited partners. So that's called the continuation fund, and GP-led secondaries have been growing a lot. There's different types of GP-led secondaries, but I only have you for an hour, so I'll stop the GP-led secondaries for there and just repeat a couple of things I said, and then I'll go back to the Q&A because I see there's a bunch of questions that I want to get to. So recapping a bit, right? I know I don't have slides, but I have very nice hands that help me make my points. Okay, so my first point was that currently in the private equity industry, we have a challenging fundraising environment. And we have a challenging fundraising environment because the firms are having difficulty selling the companies at the current values that they're saying that the companies should have, right? And there's a lot of issues with the actual valuations they have, and investors are frustrated that they're not getting the money back, okay? And so then we went to our second trend, which is, okay, so they're not selling it in their traditional channels, which is to a strategic buyer, financial buyer, and to the public markets. So what they're doing is they're selling to themselves through a GP-led secondary. So those are the 2 biggest trends. We have a third trend that is actually maybe, I don't know, is it even bigger or not? I'll let you judge when we get there. Now, there's a lot of nuance when it comes to the actual GP-led secondaries. So here is the challenge that you'll have when you try to read about GP-led secondaries. If you go on the internet and you look at anything on GP-led secondaries written by any of the private equity firms, which is really who writes everything, the private equity firm will always say that the reason they're selling to a continuation fund is not because of the fact that they have trouble selling. Like, they would never say that. The private equity fund will always say that it's their prized asset that they want to grow and has the opportunity to grow lots. And so you have this unique opportunity to buy into a continuation fund to have access to this prized asset. And so just realize in private equity, there are always 2 sides to every story. And so the other side to the GP-led secondary story is that there are prized assets. Now, in reality, this is actually a fair argument by the private equity funds. Think of it, right? They might have a company where maybe internally they've been able to change the operations, make it more efficient, and maybe grow. But because of the uncertainty in the global markets, because the interest rates haven't come down as much as they maybe should, because of the fact that people are not putting as much capital to play, because of the fact that other investors or people that they would exit to are not willing to pay the high valuations they want, they actually have a good company that could grow and actually sell at a high valuation in maybe 5 years. And so that is why it might actually make sense to hold on to this. But investors, a lot of times, want to see a real exit. Investors want to see an exit to a strategic buyer, a financial buyer, an IPO, because that's a real exit, because they believe sometimes these other exits that have a conflict are manipulated so that the private equity funds can get fees. So that's what some investors have. And so your traditional investors, your sovereign wealth funds, your endowments, your pensions, your family offices, also insurance companies are in there. When your traditional investors are frustrated with private equity, they're not putting as much money into private equity, which is why fundraising has slowed. And so my third biggest trend, I'm just going to say the trend and then we'll get to the chat for the other two. The third biggest trend is going to be what all of the private equity firms are doing to solve the fundraising issue. Do you know what that is? If so, if you want to know, stay tuned until after I answer these questions, and then I'll tell you. So Raman, I think I have some questions. Are we ready to go?
Is by Subukti. Hi, Steve. When lending to a company backed by PE, how to assess the likelihood and capability of the PE to give funding support when needed? Thanks in advance.
Okay. I just want to. I might need some clarity. Okay. So when lending to a company backed by a private equity firm, so you're a bank and you're lending to a portfolio company of a private equity firm. You want to assess the likelihood of the PE fund give additional support or equity injection. Okay. So gotcha. Okay. So if I'm lending money to a company that's owned by a private equity fund, okay, what you need to do is you need to actually do the due diligence based on it not receiving any equity injection. You cannot get, like, it's very difficult for you as a lender to try to get some sort of promise from a private equity fund in writing that if there is challenges, they're going to put in more equity, right? Some of them might say it, but it's very difficult for a private equity fund when you say lending that they're going to put in more money. Now, this could be a negotiation. You could say, I'm not giving funding if you don't give some sort of guarantee. So you could give some sort of get some sort of guarantee for a private equity fund, but that most likely doesn't happen. And so you're going to have to assess the company on its own. Actually, maybe I can kind of get into a little more detail on this because I remember all of the big banks in Indonesia have come to our boot camps, and there's a common issue, I think, when banks in Indonesia are trying to lend to private equity funds that are trying to go to Indonesia. And I think you're going to have more and more, as you know, Ares, which is the biggest private debt firm in the world, they just bought some of the funds from North Star, which is a private equity firm that is investing in Indonesia. So I think, this kind of issue will be bigger in Indonesia. So why don't I go through it? So in a private equity fund structure in North America and in Europe, usually what you have is you have a fund that'll have 10 different companies, roughly 10. But here's the thing. Each company, when there's a loan, so if I'm a private equity fund and I buy a company, okay, I'm going to do a leverage buyout. Let's make the assumption I'm buying it with 50% equity and 50% debt. Okay, so if I'm a private equity fund, I'm buying a company, 50% equity, 50% debt. The debt is actually not using the collateral of the private equity fund. The debt uses the assets and the cash flows of the company, the portfolio company, as collateral. Okay. Now, this is common in North America and Europe, but in my time in Indonesia, it could happen, but it's not overly common. So you you're only with this company by itself. Okay, so you only have the company by itself. There's usually no personal guarantees. There's no guarantees by the private equity fund. In fact, in the US, the idea is they'll do 10 different companies, and if 3 companies end up going bankrupt and 7 companies do okay, their fund could actually make a good return even though 3 companies go bankrupt. Which if you intuitively think about it, it's kind of crazy because these 3 companies would not go bankrupt without the leverage. And so the logic of the private equity industry when they have a fund structure, and the argument on why they do this, is they say if I buy 10 companies, independently they get their own loans. So every bank that's loaning to the company has to loan to the company by itself. But then the company can actually go under and they won't actually put in more support. They'll say, okay, this is a loss, let's leave it and let's go to the next company. And then all they care about is the return of the fund, not the return of the investment, which is a very different way of thinking about it, right? If you come from a place where if someone is buying a company, they'll give a personal guarantee, they'll put their personal assets against to it. Well, that's something. But in a private equity fund, you don't have that. So Sabikti, I'm hoping I'm answering your question, where it's very difficult to get any guarantees. You're going to have to do your analysis, and it's just any basic analysis on when you're giving a loan. So remember, when you're giving a loan, it's a little different than when you're looking at equity, right? You're looking at the downside. So you're going to look at the assets and the cash flow that are there to support the loans. And you're going to look at your typical ratios, debt to EBITDA, interest coverage, and stuff like that. So it's a little bit of a long answer, but I hope I covered that. Rama, should we go over to the next question?
Yes. The next question is from Vito Alexander. What will be the main catalyst for PE industry growth?
The main catalyst. Oh, that's good. I have to answer once because he said main, it's one. So I can't get out of it, and I can't say like 5 different things. I have to say the number one thing for PE industry growth. So Vito Alexander, I'll tell you this. The number one catalyst for PE industry growth is actually my third trend that I'm going to get to after the questions. Okay, so I'll come back to your question because you're my third trend, and I actually have a bunch prepared to explain the third trend, and I'll get some people to guess it. So I promise you I'll answer that question. But I see some other questions that maybe I'll answer now.
Okay, from Peter. Hello, Steve. I'm Peter. I have a question. In the stock market, to buy stock is using market price. How about when investor buy stock PE? What price is used to invest in PE?
Peter, you use your ability to negotiate. That's what you use. Okay, so if you want to buy, so the price of a private company is the price that you're willing to pay and they're willing to accept. That's the price. Now, sorry, that was more of a joke, but that's actually true. But how do you get the price? So internally, you're going to do your own valuation. Now, I'm sure the CFA Society Indonesia has some great courses on how to do valuations, or if they don't, I'm happy to help. But basically, the idea is, I'll do valuation in 2 minutes. So valuation, the way you value a company is intrinsically and relatively. So you can do intrinsically as like a discounted cash flow model or separate intrinsic models, which you can do for an industry-specific way. It's by you actually forecasting the cash flows and discounting it back by a weighted average cost of capital based on your assumptions. So it's intrinsic valuation. And then there's relative valuation, where you're trying to find similar companies in the public markets and use a multiple, such as enterprise value to EBITDA or something similar, to find the price. But in reality, valuation is something you do on your own to kind of figure out how much you want to pay. But the amount you pay is what you can negotiate. And that's why so many people are attracted to private equity, because of the fact is the market is actually not efficient. The public markets are, well, I don't want to say the public markets are efficient, because that statement can cause me some good debates and good arguments. So I'll say some people say that the public markets are efficient, but what we can say with confidence is that the public markets are a lot more efficient than the private markets. And the reason why people like the private markets is because of the idea that you can have alpha. And one of the number one ways that you can create alpha in a private equity transaction is by good negotiation and by buying low. I'll stop there, and I'll pass it back to Rama. What's the next question we have?
Okay, next question from Santa Lidwina. Is the continuation fund the same thing as restructuring an investment to extend the holding period with the goal of achieving a higher expected return?
Not really, Santa. So let me go back. Okay, so an investment, because a continuation fund could be used for multiple investments. And the idea of a continuation fund is really, what you're doing in a continuation fund is you're not restructuring the investment. You're restructuring the ownership of the investment. Okay, so I'm going to repeat that again. You're not restructuring the investment, and I'll get to restructuring an investment in a second. You're restructuring the ownership of the investment. So in your fund, you have a 10-year time period, and you're getting up to the end of your 10 years. And some of your investors want their money back. So for example, your sovereign wealth funds and your pensions. So for example, in Canada, we have something called CPP Investments, which is our biggest pension that invests in private equity, one of the biggest private equity investors in the world. They do something called the total portfolio approach. So the way, if CPP wants to invest in something, they have to sell something else. And so they plan in advance to sell the private equity fund investments and to get the money, because they have something else they need to use it for. And so investors like pensions will need the money from the private equity fund. And so the private equity fund needs to restructure who owns it because some investors need the money back, but some investors want to continue holding. So you're restructuring the actual investors. When you restructure an investment, I'll just maybe answer this in 1 minute because I know we have lots of questions, and I see that we now have over 105 participants that might have more questions. So I'll just answer this super quickly. When you have an investment, and let's say you're not making your interest payments, right? You might need to restructure. So the way it works in private equity is there's something called a liability management exercise. So this is the restructuring before the restructuring. Let me explain. So if things are not going well in private equity, which means your debt holders are having trouble getting some of their money, what will happen is the private equity fund, the company, and the debt holders will try to negotiate an agreement to try to make this work before there's bankruptcy. Now, in the United States, there's two main types of bankruptcies, Chapter 11 and Chapter 7. So Chapter 11 bankruptcy means the company can still have ongoing operations while it works itself out and does the restructuring. Chapter 7 bankruptcy is when there's liquidation. And so while Chapter 11 is restructuring under bankruptcy, there's a liability management exercise, an LME, that can happen before the bankruptcy. So I won't go into too much detail because we have lots of questions, but the idea is there's restructuring of the investment, but a continuation fund basically just restructures who owns the investment. Okay, I'll stop there. Rama, do we have more questions? And then you let me know when I should go on to my trend 3, and then
go to trend 3 first, Steve.
Okay, and then we'll come back to questions. Okay. Okay, great. Okay, so trend 3. So remember trend 1. You thought I was going to tell you what it is. No, I'm going to make you think. Because if I tell you what it is, you won't remember. And I want to make sure when you get off this webinar that you don't say, oh, that was a great webinar. And then you talk to someone in your family for dinner and they say, what did you learn in the webinar? And you say, oh, I don't remember, but the guy had lots of energy and waved his hands. I don't want that. I want you to remember the 3 biggest trends in private equity. So now I'm going to kind of make you think. Okay, so I apologize for making you think. Okay, so the first trend was... That's right.
Chat, please.
Oh, yeah, we can do it in the chat, but are you okay if I do it in the chat? Are you okay to keep up with the...
Yeah.
Okay, cool. Okay, so in the chat, what was the first trend? This is a test. Okay, Rahman, I'm not seeing anybody passing the test. Okay, good. And Hika says a challenging fundraising environment. Okay, amazing. Good job, Hika. Okay, so what was the second biggest trend? So challenging fundraising environment was the first trend. What was the second biggest trend? Second biggest trend. Anybody have it? Second biggest trend. First is exactly, right? The rise of GP-led secondaries. So you have a challenging fundraising environment, and then the second one is the rise of GP-led secondaries. Okay, so let's use these first 2 trends to try to figure out what is the biggest trend in private equity today, which will also answer the question that we had earlier about, I'm trying to find the question, but there's lots of questions in this chat. Oh yeah, what is the main catalyst for private equity industry growth that Vito Alexander asked? Okay, so I'm going to make you think again, so I apologize. I know it's late, but it's early for me, so I'm fresh, so it's okay. Well, it's okay for me. Okay, so if we're having a challenging fundraising environment and we can't raise as much money we can from sovereign wealth funds, insurance companies, endowments, pensions, family offices, but we want to fix that, right? We're a private equity firm, and private equity firms make the majority of their money through management fees, which are recurring fees. They love, I don't know the majority of their money, but this is sticky money. So private equity firms love management fees. Management fees are based on the assets they've raised. So if you're a private equity fund and you want to raise more money and you know it's a challenging environment, what do you do? I'm looking at the chat. What do you do? What do you think the third trend is? What are the private equity firms doing right now to raise more money? So I see Santa wrote ESG and sustainably driven investing. So it's a great point. The private equity firms are investing more in sustainability, and I think this varies across fund and across sector, but that's a good point. But that's not how they're raising the funds. So how are they raising the funds if the sovereign wealth funds, endowments, pensions, if they're not re-upping as much? How do they do this? Any idea? Who would the private equity firms try to raise money from that in the past have never been investing in private equity? So who of the private equity firms? Exactly, Cyril. So Cyril, great answer. So Cyril wrote retail in the chat. So the private equity industry, which is your third main trend, is going after what's called the private wealth channel. So since private equity has started, it's really was only available for people with a certain amount of money, the wealthy families or pension sovereign wealth funds endowments. That's been the industry forever. Why? Because of the fact that companies are liquid and you need enough money that you can invest and you can hold it and then you can get it back at the end. And you need enough money to buy companies. Now, the private equity industry has wanted to raise from the everyday person, the private wealth channel, through wealth managers, through advisors, through banks. And so the private equity industry needed to create a product that is different than the traditional closed-end fund. The traditional closed-end fund was created because it takes time to find a private company to buy. You have to buy it, create value, and sell it. So you created a 10-year fund. But the 10-year fund is not optimal for your everyday investor. And so the private equity industry, which is the third biggest trend, and I would argue this is probably the biggest trend in the industry, and that is the new evergreen vehicles. So evergreen, we have lots of evergreen trees here in Canada. So evergreen means that it's going to last forever. Some people will call them perpetual funds. Some people call them evergreen funds. Some people call them open-ended funds. But what they are is they are funds available for your everyday investor. Now, let me explain how this works, because the companies are still private. It still takes time to find a company to buy, to negotiate a deal, to do due diligence, and to buy a company. Okay, so the retail investor still cannot put money away for a long time. And so these evergreen funds are created in such a way that they are liquid. Now, how does that work? How can you make private companies that are illiquid liquid? So let me explain. And by the way, we're going to post this, I think, on YouTube. We're recording this if you want to see it. But also, I have a YouTube channel with over 300 videos. We did a 15-minute video called Liquid Private Equity, where the trend I'm about to talk to, we interviewed a lot of people offering it, and we went into a lot of detail. So I'll do it a little shorter because I see there's more questions in the chat. So I'll do a short version, but if you want the longer version, we can get to that, or you can ask questions about it. Okay, so let me do the short version. Now, this is it sounds like it's easy to do. You know, when I'm in a classroom and I ask my students to be concise, it's very easy for me to ask them to be concise. But the process of actually being concise is actually very hard. So I'm going to try to do that right now. Okay, so an evergreen liquid vehicle. Let me explain how this works. You have companies that are big private equity firms. Blackstone, KKR, EQT, CVC, Blue Owl, lots of companies that are big private equity firms. So what they do is they create a liquid vehicle, right? If you want to look up a ticker, I think it's BXPE is the Blackstone one, but a lot of the private equity firms offer this. And the way it works is you give money to the vehicle. Then usually there is a 2-year lockup period. Now I know what you're thinking. I said liquid. How can there be a lockup period if it's liquid? Well, there's a lockup period, but you can still get your money at a penalty, right? So it's a small penalty if you want to sell early. So you're locked up for 2 years. After 2 years, you can actually redeem every 3 months. So every 3 months, every quarter, you can redeem from this fund. Now, what's in the fund? I'll get to that in a second. So you give the money to the private equity vehicle. You're usually locked in for 2 years with maybe a penalty if you want to sell. But after that, every 3 months, you have the opportunity to sell. So it's liquid. Now, how does the private equity fund offer a liquid vehicle for illiquid investments? Great question. I know it's my question, but great question. Okay, let me explain. Okay, so the way it works is, first of all, the private equity fund tries to raise more money than it gives back, right? So over the last few years, the private equity industry has done a great job explaining to the everyday investor why they should be in private equity. Now, we could argue if the retail investors should actually be in private equity. That's a whole argument that I'm happy to go over if you have a question on it, because I don't think that it's as clear-cut as the private equity firms say. So private equity firms come up with this great marketing material saying private equity outperforms the public markets. They pick a benchmark that makes everything look good. They pick a time frame that makes everything look good. They give a cut to the wealth manager that sells it to the client, and then they're able to get more money. There are lots of problems with that, but I see we're at I was going to say 8:51, 7:51 your time, so I'm not going to go into the problems. I'm happy to do it in Q&A. Okay, so what they end up doing is they raise more money than they give out. But they also have what's called a cash sleeve. So they have extra cash available in case that what happens is more people want their money than want to put money in. Another thing they have is a line of credit from the banks to make sure that they can borrow money so they're not stuck. Because after all, they don't want to be in a situation where they have to sell a company at a lower value because they're forced to sell. Now, the last thing, which is a big issue, or could be a big issue, is even though it's liquid until it's not liquid. So how does that make sense? It's liquid until it's not liquid. Let me explain. There's something called redemption gates. So a redemption gate is when, just like it sounds, investors are gated from selling the private equity investment, which means that they can't get their money out. Now, usually the redemption gates are set at an amount of 5% of net asset value per quarter. Now, in the event that more people want their money out, the private equity fund says no, they gate it, and people can't get their money out. Now, this has not been an issue in the private equity industry yet, but here in Canada, it's currently a big issue in the real estate industry. We have many funds that are evergreen funds in Canada that have been indefinitely gated, which means investors have their money in, but they were supposed to get it out, and the firms won't let them take it out. So it is a challenge for the industry. So I see lots of questions in the chat, so thank you for your questions. I'm going to bring everything together, and then I'm going to conclude, right? And then what I'm going to do is open up for questions. So the 3 biggest trends in private equity today is, number 1, we have a challenging fundraising environment. After all, the private equity funds are not able to sell these companies for what they're valued at to strategic buyers, financial buyers, and the public markets. And so investors are hesitant to put more money out. Number 2, that's number 2. I can count, I promise. Number 2 is that private equity funds are selling the firms to themselves because they have trouble selling to strategic buyers, financial buyers, and to the public markets. And your final trend is the private equity industry is trying to solve these fundraising problems and really continue to have more money to invest by trying to raise money through its evergreen vehicles, which goes through the private wealth channel, eventually the retail channel. Now, we started off today by talking about the future of the private equity industry. We know that there's an uncertain global economy going on right now. There's a lot of issues with potential tariffs. There's a lot of countries that aren't getting along as well as they used to. Also, we have higher interest rates than we had through the 2010s, which one would argue the 2010s were the golden era for private equity. So the question is, what is the future of private equity? Is it going to be challenging? Is the private equity industry going to be resilient? Well, that's for you to decide and for me to answer through any questions you have. So thank you for coming. please, I'll open the floor for questions. And Rama, maybe since we have a bunch of questions already in the chat, I'm happy to go through those.
Yeah, from Marceliano Christopher, you want to ask what's the difference between private equity fund and hedge fund?
Okay, great. So a private equity fund, well, I was going to say only invests in private companies, although there's actually technical ways that they do like a private investment in a public vehicle. But overall, just as in general, a private equity fund is usually 10 years in length, has committed capital, invested capital, doesn't take all the money up front, and invests in private companies. Like overall, there are exceptions, but overall, that's what it is. A hedge fund could invest a lot in the public markets with various strategies. I'll give you I started my career at a hedge fund, so let me give you two examples of the strategies. So one would be a long short strategy. So you can buy stocks and then you can short stocks. Shorts is selling stocks you don't own, which is a complex topic, but I'll just leave it there because of our time. So you could actually buy stocks and short stocks, right? And then that's a hedge fund with the public markets, where you can't really do that in a private equity fund. Another thing in a hedge fund that happens very often is what's called various arbitrage strategies. So one example would be merger arbitrage. So for example, some of you probably saw that the Saudi Arabian government, PIF, Silver Lake, and Affinity Partners, which is a private equity firm owned by Jared Kushner, Trump's son-in-law, they're buying EA Sports, and EA Sports is they're trying to bring it private, so it's a public company, but the actual deal hasn't gone through. And so the way it works is there's a difference between the stock price when you're about to buy it, when it actually goes through, and hedge funds will play on what's called merger arbitrage. So if a company is about to get bought by a merger, but it's not all the way through, they will use their information advantage to figure out if the government's going to put it through or not. So that's a quick answer. Maybe I'll leave it at there because I see the chat is filling up with questions.
The next question from Edgar.
Yeah.
Hi, Steve. As a retail investor, what is the best way to gain exposure to private equity through ETF or publicly listed PE firm?
Okay, Edgar, thank you.
Saratoga in Indonesia.
Yeah, so Saratoga is a public vehicle that you can invest in. It's good. And Salamat Malam, Edgar, thank you for your question. So I think, you can invest in public private equity firms. That works. Usually by investing in the stock of a public private equity firm, you are now basically owning a part of a private equity firm. So your stream of income, usually when you buy the stock of a private equity firm, comes from their management fees and performance fees. Now, some private equity firms will have public vehicles that you can invest directly in the LP, where they take LP stakes and do it. There's lots of different options like that. I usually don't like a lot of those the options that are trading publicly, just because they're subject to the volatility in the public markets. So for example, all it takes is someone to make a tariff announcement, and then the whole company will go down by 5% or up by 5%. And whereas if you invest in a private equity directly, a private equity investment directly, you'll have it for the long term. You know, Edgar, if you really want to get into private equity as a retail investor, maybe some of the evergreen vehicles could be okay for you if you want to kind of touch base on some of them. But I think, private equity is a little more sophisticated than you'd guess. So I'm not sure actually it is the right play for a retail investor to be in private equity, which is not so great because I'm the one trading private equity. I'm telling you not to do private equity. But as a retail investor, I'm not sure that private equity is right. As a retail investor, here's what you need to do. You need to look at your portfolio, look at your liquidity needs. What do you need the money for? Look at your time horizon. When do you need the money? Look at your tax considerations. Look at your legal considerations. Look at your unique circumstance. Based on that, you need to build a portfolio. That portfolio may or may not have private equity, may or may not have real estate, but do not invest in an investment because someone tells you you're going to get a 20 or 30% return. You should have a plan. You should have a strategy. Your strategy should be based on your needs, and then you should have investments that actually go into the strategy. And those investments should be diversified across sector, and everyone's going to have a home bias into their own country, but you should also diversify across geography. The actual vehicle, whether it's private equity or not, I think is less important. So I'll pass it back to you, Rama.
Yeah, a follow-up question from Subhakti.
Yep.
So if a PE needs banks to give loan to the company, they invest. If an invested company went bankrupt and the bank did not get the money back, will that hurt the PE reputation among banks?
Subhakti, it should. I would tell you it definitely should. But here's the thing, right? Like it's like usually, usually the banks and the private equity firms have done hundreds and hundreds of deals together, right? So overall, like if it's a first time, then yeah, but most of the time, they've been working together for a long time. It's a long-term relationship. Like in the EA Sports, the EA example, like JP Morgan, I think, is giving an 18 or $20 billion loan. In the Skechers, I don't know if you've heard, there's a shoe company called Skechers, which is getting bought by a private equity firm for, I think, $9.4 billion. The biggest lender there is also JP Morgan, right? So they've done this a lot, right? And so overall, the way like the banks that associate with private equity, they also have a plan. Their plan is overall how much they're going to kind of do with private equity. They look at their, their ability to recover on a default. They kind of know how to do these liability management exercises. So before the company actually goes bankrupt, the bank is involved in the discussion. And really, if the bank has a good relationship with the private equity firm, they know things are coming. And really, a lot of times, bankruptcy, yes, there's fraud here and there, but a lot of times bankruptcy is because of the fact that they've tried a strategy that maybe didn't work, or maybe the overall economy changed, right? But a lot of times they're kind of executing their plan. It's just, there's different reasons why. And I think as a lender, it's understanding why they're going bankrupt. Right? Are they going bankrupt because they're a .com company in 1999 and you for some reason lend them money and then in 2001 when it crashed you lost money? Or are they going bankrupt because they're a manufacturing company somewhere in Asia that has been been efficient and been doing a great company, but has been affected by tariffs, which make it no longer economical for them to be a company? If it's the second one, I would argue that doesn't hurt the reputation as much. So unfortunately, I'm going to have to give you the answer that I give to my students, which they don't like. And the answer is, it depends. So I apologize for that answer.
Okay, next question from Santa. Which
Yeah.
sector in Indonesia presents strong potential opportunities for private equity firms to invest in and attract capital?
In my opinion, in Indonesia, you have lots of energy and minerals and resources. And I think there's a really good resource sector in Indonesia. So that's one. Another one is the fact that Indonesia has 280 million plus people. You have a big consumer market that's growing. I think there's a big opportunity for a consumer market outside, like the international global private equity firms. A lot of them, were in China and India. A lot of them are very big in India. A lot of them were big in China, and some, just because of the potential global conflicts, might be actually going to other Asian markets. And so I would make the argument, just based on a quick answer, would be the energy sector and resources and minerals, and that would be more getting the government involved with some of those, and then on the consumer sector because the consumer is growing.
Next question from Jovian. Why can't retail investors sell their evergreen fund to a third investor just like stock and bonds?
So there's a redemption. So you're redeeming it from the company. So you're thinking of creating a secondary market for your fund investments. Right? Think of how a mutual fund works, right? So a mutual fund is you buy through your bank and they own it. Right? You can't sell some stuff you can sell, but some you can't sell to other investors. You have to redeem directly from the bank. And then the reason why you can't do that here is it's kind of controlled for that. Now, could you sell it on a secondary? Could that market evolve over time? Probably can evolve over time, which you'll have it. But usually what ends up happening is when it's kind of like a run on the bank. When everybody wants their money out, there's going to be a lot more sellers than buyers. And when that happens, that's going to be a lot harder to sell. So I'll stop there because I know we have more questions.
Okay, next question from Alvin. If the country has had rising political risk and skeptical co-investor, which exit route will you choose to preserve value stage? Secondary sale, GP-led continuation, or local partner buyback, and why?
Okay, so let me talk this through. Okay, so Alvin, so thank you for your question, Alvin. Okay, so you basically have political risk. Okay, and I'm just going to repeat just to make sure I understand your question. So you're having extra political risk, and what you have is you have co-investors. So in other words, other investors. And I'm making the assumption from your question that the other investor is from another country. I'm making that assumption, but I could be wrong, and correct me if I'm wrong. So you're saying you have a co-investor from another country, and now you want to actually make sure that you don't get a hit on the value, and you want to preserve the value. Okay, so I think the way how you preserve value when you basically what you're saying is you're trying to actually sell someone else's stake. So what you're trying to do is you're trying to find a buyer that is going to pay the price that you think it's worth, right? So you need to. So the question is, can you find that buyer? So what you should be doing is a multiple track process. So traditionally, when a private equity firm or a fund wants to exit, they do something called a dual track process, which means they do the papers to go public, but in the meantime, they try to sell to a firm. And if they can't sell to anybody, they just go public. But if they can sell to someone, they try to sell to someone at a higher price than the public markets. And so your job when you're selling something, okay, what you want to do is you want to find the ideal buyer. And the ideal buyer usually is a strategic buyer. So you first want to go to your strategic buyers and see if they want to buy it. Now, the issue with a strategic buyer is your competitor. And so if your competitor gets all of your proprietary information, that's a problem. And so usually they'll pay the highest price, but they're a risky buyer when you sell it because they can get all your proprietary information and then pull out of the deal. Next, you want to look for some sort of financial buyer. Is there a local partner? Is there a local investor? Is there a family office or anybody that wants to invest in the country that can take the stake? You should talk to them. Okay. Then the third one, you probably won't bring it public based on the question you gave me. So if you're a private equity fund, can you do a GP-led continuation fund? Well, you can only do a continuation fund if you have people. So the person that's exiting, if people don't want to buy the thing that they're exiting, right? Because if the only reason a continuation fund works is because there's someone that's continuing the investment. So you need to actually find someone that's going to buy the exiting investor's spot. So that's the idea. So if you have a follow-on question, let me know. Or Rahman, I'll trust you. What should I do next?
Okay, with Mega from Cyril, with Mega Fund acquiring regional player, is consolidation inevitable?
Yeah, so Cyril, that's a great point. I believe that in 5 years, you will have a fraction of the private equity firms globally that you have today, right? I think in the mid 2010s, interest rates were low. Everybody can invest in private equity. Anyone can create a private equity fund. Everyone was being able to raise. I think all the big investors were just allocating more and more and more money to the private equity industry. And so a lot of funds were raised that I'm not sure deserved to get the money, but they got the money, right? A lot of people raised money. I think one by one, the mega funds are acquiring players. I know we talked about earlier, Ares buying North Star, which invests in Indonesia, but there are tons. If you look any day, you see there's tons of consolidation. One thing which is my bonus trend, which I was doing questions instead of my bonus trend, is the increase of private debt. And you'll see a lot of private equity firms are also buying private debt firms. And so you're not just consolidating private equity, you're consolidating alternative asset managers, right? Like EQT bought Exeter, EQT bought, which is a real estate company, EQT bought Baring Private Equity Asia. So I think consolidation is definitely going to happen. I'll leave it there. I have a lot more on the topic, but I'll leave it there because I see more questions.
Okay, Vincent is asking about how to reach out to you, to contact you.
You can reach me. You guys can all add me on LinkedIn. Feel free to add me on LinkedIn. That's an easy way. You can also see me in person. I'm going to be doing multiple events for CFA Society Indonesia. Rahman, I know we're doing the boot camp. Feel free. I guess they can always see me in person. I'll be in Indonesia for 3.5 weeks. So I'll be doing some events with Rama, Dewi, and the rest of the CFA Society Indonesia team, which I'm very excited for. But if you want a quick question, you can get me on LinkedIn. I don't know, Ramat, do you want me to add anything there?
That's fine. You can reach out to us if you want to contact Steve or attend the event in Jakarta in November. Yeah. And then from Subakti again, are you familiar with TPG and Digital Bridge and whether they have been maintaining track records of not having any of their invested company defaulting on their renders?
It's a great question, Subekti. I'm not so aware of that specific investment, but I'm gonna look it up. And Subekti, if you want to add me on LinkedIn, if you add me on LinkedIn and message this in the connection request and you ask this question, I'll make sure I have an answer for you. I'll make sure I for sure have an answer for you. Okay, so I don't know the answer offhand, and I don't want to pretend that I do. So I'll stop there.
That's the last question, Steve. If anyone else have any question, can just unmute and speak up. If you are shy, you can still type in the chat.
Raman, I think we have another question in the chat, and thanks, Subekti.
Muhammad Faisal PE. Sorry, Muhammad Faisal. I don't understand what you mean PE. PE is private equity or price earning? Yeah, private equity. Okay. Any last word or any question, everyone, before Steve give his last comments?
I think maybe I see. Maybe I can. I think Mohammed was talking about data centers, and maybe I can just make a quick comment on that, Rahman, if that's okay.
Okay, go ahead.
So I don't know if you remember, Rahman, last year we did a speech for CFA Study Indonesia in Jakarta, and the majority of the speech was about the growth in digital infrastructure, right? Where AI, so generative AI has been growing around the world, and investors are always looking at different ways to invest in AI. The challenge, of course, is, what are you going to invest? You're going to invest at OpenAI at a multiple $100 billion valuation. Well, that's kind of a risk based on the valuation. And so what a lot of private equity investors are looking at is okay, what drives and what powers generative AI? And so to actually power generative AI, you need data centers and you need this infrastructure. And so there's been a massive build out for data centers around the world. Now, technically, usually you're not finding these investments in private equity funds. Technically, these investments are in digital infrastructure funds or in general infrastructure funds. So you actually have private equity, which are now called alternative investment firms, having private equity funds, having private debt funds, but they'll also have infrastructure funds. And so your question, Mohammed, is how do you do actual data center? I'm trying to make sure I understand your question. Like, what are you looking at a company's performance in telecom, I think? Is your question? I'm not sure I understand your question exactly. So why don't I talk a little bit more about the data center development, right? So basically, you have different types of data centers, right? You have hyperscale data centers, which are the ones that are built by, companies like Amazon or Microsoft. But then you also have your co-location data centers, which are companies like Equinix or Digital Realty that you can publicly trade, and they own data centers with the idea of actually, renting out space in the data center. And so the investment in data center can happen multiple ways, right? You can invest in a company that has AI that owns data centers, where it's a small portion. You can invest in a public company that owns data centers, or these private equity firms that invest in data centers directly. I'm not sure if that's what you're asking, but anyway, that's what I'll say on data centers.
Steve, maybe I can clue you in. Muhammad Faisal is one of our participants in this year research challenge.
Oh, okay. So it's a question I know.
Our subject company is PT Telkom, the Indonesian telecommunication company.
Okay.
Main one. And Muhammad, please be aware that Steve Balaban is the mentor for the champion team from Toronto 2 years ago. Right, Steve?
Yeah, so I'm happy if Mohammed, if I see you in person, I'm happy to give you my thoughts. And just a quick comment, Jay, who's on the call right now, is on our CFA challenge team for Waterloo this year, and we're doing a kickoff party tomorrow night. So we're going to go out to a bar if anybody wants to come in. If anyone happens to be in Toronto, it's a little far from Jakarta, but if you want to come out, we have an event tomorrow night. But that's okay. That's okay. Oh, maybe.
One more question, Steve, from Masiliano.
Yeah.
If I want to work at private equity, what kind of skills should I prepare from now? And how's the roadmap after 10 years from now?
Okay, so if you want to work in private equity, well, obviously you would come to the boot camp we do in Jakarta. That's the number one way. No, just kidding. Okay, so if you want to work in private equity, here is the roadmap you should do. You should look if let's say you're located in Jakarta. What you want to do is you want to find people that are currently in the positions that you want to go to, right? So you want to find people that are maybe a few years ahead of you. You want to meet them for coffee. You want to find them informally. You want to come to private equity events, and you want to talk to people to figure out, kind of what skills they use on a regular basis, right? It's critical thinking, it's problem solving. You want to have a background. There's a bunch of, investment banking guides that you can look at on the internet that'll help you kind of with some of the fundamentals. right? There's lots of events that I know Rahmat throws at CFA Indonesia when I'm not there that will also help you. So I think it's just kind of immersing yourself in the community, talking to people that are already there, and then going from there. I think that's the best way to do it. But happy to talk more if I see you in person in Jakarta. And then I see Mohammed Faisal ask, where's the party? Sorry, Mohammed. The party is going to be the party is in Toronto tomorrow. That being said, we'll be throwing many parties in Indonesia. I'm going to be there for 3.5 weeks, and I think we'll have many parties across multiple cities. But you can write to Ramat about that and see about that. Is that a good way to say that, Ramat?
Yes. Because we prioritize CFA charter holders, CFA candidate, our past participants in our masterclass or bootcamp, and also, of course, your clients.
Okay, sounds good. Sounds good. Perfect. Okay, so hopefully we'll have a chance to party together. I see there's still, 80 something people still on this call, and so for the 80 something people that are on this call, I'm really excited to hopefully meet some of you. Come out to one of our events. Come out to something. Would love to meet you in person while I'm in Jakarta. I'm going to be in a few other cities as well. So when I'm in the different cities, please come out. Please come introduce yourself. Say hi. I'd love to meet you in person.
All right. Last chance for questions.
Maybe just a final comment. I just wanted to thank Ramat and Dewi. Guys, thank you for having me. I really appreciate you. Did an excellent job organizing. I always love working with you, and I'm very excited to spend time with you when we get to Indonesia. So thank you so much for organizing this event. Really appreciate it.
Pak Rahmat,
Ya,
hi
silakan.
Steve. Yeah,
Hai,
yeah.
Bu Rahma.
Hi Steve. Thank you very much for your sharing to our society tonight. I'm listening, but unfortunately I'm doing something else. But I can feel your vibes, and this is so inspiring to our society. So thank you very much, and I hope your bootcamp will be gain more participants from our members. Okay.
Excellent. So, thank you so much for your welcome. I appreciate it. Terima kasih, and thank you for saying that. I appreciate it.
Okay, thank you. See you next time.
Thank you. We'll see you soon. We'll see you soon.
Yeah.
Okay,
Thank you, Pak Rahmat. Thank you.
Thank you, Bu Rahma. All right. If no more question, thank you, Steve, and your team. We will see you again in 4th November.
Excellent. So thank you, Ramat. Thank you, Dewi. Thank you, CT. Thank you, team. And also just a quick thank you. I want to thank, you probably see Marcel over there, who's been helping with a lot of the planning for this. I want to thank Fadia, and I want to thank Alfin and Brian. You guys do all the stuff in the back end to make us ready. And so thank you for your help. Appreciate it.
All right. Take care, everyone.
Terima kasih.
Have a
great night.
morning, Steve.
Thank you.
Thank you, everyone. Bye.
Thank you.
Bye.
Bye-bye.
Selamat